Welcome to today's video, where we unpack why trading in a car just 6 months after purchase can be a financial disaster, and how to recover smartly. We will move from the emotional frustration of sudden repairs, to the hard numbers behind depreciation, the reality of negative equity, the limits of legal recourse, and a step-by-step recovery plan. Stay with me, as we build from foundational concepts to actionable strategies. Here's our roadmap. First, we'll define the early trade-in trap, and show how negative equity forms so quickly. Next, we'll quantify depreciation so you can see why the trade-in value usually doesn't match your loan payoff. Then, we will clarify legal myths around used cars and warranties. After that, we will present the most financially sound strategy and a practical recovery plan with timelines and numbers. We will also include short quizzes to test your understanding before finishing with key takeaways and next steps. Before we dive in, a quick disclaimer. This content is for educational purposes only and is not legal, financial, or tax advice. Laws and consumer protections vary by jurisdiction, and every loan and vehicle situation is different. Please consult with qualified professionals for advice tailored to your circumstances. With that established, let's transition to understanding the trap itself. The trap begins when you consider trading in a car just months after purchase, especially if you finance with little to no down payment. Because vehicles depreciate fastest at the start, your loan balance often exceeds the car's value. If you accept a low trade-in offer, you either pay the difference out of pocket or roll the shortfall into a new loan, which compounds the problem. Now, let's quantify that depreciation to see how the math plays out. Depreciation hits hardest in the first months of ownership. Your lender's payoff balance does not change in step with market value, so your payoff is almost always higher than what a dealer will offer as a trade. After 6 months, especially if the car is non-operational, offers can be drastically below your payoff. The gap becomes your responsibility. Either you pay cash to close it, or you roll the negative equity into your next loan, which increases monthly payments and interest cost. Non-operational vehicles are penalized further because the buyer must budget for transport and repairs before resale, driving your offer down even more. Next, let's define negative equity and how it traps you. Negative equity occurs when your loan payoff exceeds your car's current market value. It forms quickly when vehicles depreciate fast and the purchase involved a minimal down payment, while interest accrues and the principal barely moves. If you roll negative equity into a new loan, you start the next loan already underwater, often with a longer term and higher total interest. This can strain your monthly budget and negatively affect your credit profile over time. Now, let's address legal myths about used cars and what protections you realistically have. For used cars, legal protections are minimal in most places. Lemon laws often don't apply to pre-owned vehicles. Your rights depend on the specific written warranty given at purchase. If the car was sold as is, you are generally responsible for repairs, even if a failure happens soon after purchase. Always obtain an independent diagnosis to understand root causes and to avoid relying solely on the party who sold you the vehicle. Keep thorough documentation in case you need leverage in negotiations or in small claims court. With the legal landscape set, let's compare your two main choices: trade now or repair and hold. Trading in now yields a low offer because of steep early depreciation and any mechanical issues. You must either cover the difference in cash or roll the negative equity into a new loan, increasing your balance and interest costs. This creates short-term relief, but long-term financial strain. By contrast, repairing and keeping the vehicle avoids crystallizing losses at the worst moment. Restoring reliability allows you to drive the car while paying down principal, so that future trade or sale values are stronger. Over the full ownership period, this path is typically less expensive. Now, let's turn the strategy into specific steps you can follow. Here is a practical recovery plan. First, obtain multiple independent repair quotes to validate pricing and diagnosis. Prioritize safety and reliability repairs before cosmetic or optional fixes. Negotiate parts choices and labor where possible, asking about refurbished or aftermarket options that are appropriate. Build a short-term budget that covers these repairs and maintains a minimal emergency fund. Continue driving the vehicle and focus on paying down loan principal, which rebuilds equity over time. After reliability improves and the balance declines, reassess your options. Only consider a trade or sale when the vehicle's value clearly exceeds your payoff. To visualize how this decision flows, let's look at a decision diagram. This flowchart starts at diagnosis and asks whether the car is repairable within your budget. If it is not, the path explores financing options for repairs, temporary transportation, or a private sale with full disclosure. If it is repairable, the chart compares the cost of repairs with the negative equity and higher interest costs you would incur by trading now. When repair costs are lower than the combined cost of negative equity and future interest, you proceed with repairs, drive the car while paying down principal, and reassess after 6 to 12 months. If equity turns positive, you may consider trading or selling. Otherwise, you continue holding and reducing the balance. There is also a branch to check for any warranty coverage and a loop to requote repairs if the initial estimates are too high. Next, let's quantify an example so you can see the numbers in action. This example illustrates how the math can play out. After 6 months, the loan payoff might be around $23,000, while a dealer could offer $15,500 for a non-operational vehicle. That creates a negative equity gap of $7,500. Rolling this into a new loan increases your total interest and often extends the term. Alternatively, a competitive repair quote of about $2,400 can restore reliability. After repairs and continued on-time payments for 9 to 12 months, your loan balance drops while the car's resale potential improves, perhaps to $18,500 to $20,500, narrowing or even flipping your equity to positive. Now, to keep you engaged, let's test your understanding with a quick quiz. Quiz time. The question is, if your payoff is $23,000 and your trade-in offer is $15,500 on a non-operational car, what is your negative equity? The options are 1. $7,500, 2. $5,500, 3. $2,400, or 4. $8,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $7,500. You calculate negative equity by subtracting the trade-in offer from the payoff amount. $23,000 minus $15,500 equals $7,500. Rolling this into a new loan increases both your principal and the interest you will pay over the life of the loan. Next, let's map a realistic timeline for recovery. This timeline outlines a 1-year recovery. At month 0, the breakdown occurs and you obtain an independent diagnosis. In month 1, you gather multiple quotes and approve essential repairs. In months 2 and 3, you drive the car reliably and begin small principal prepayments. Through months 4 to 6, you maintain the vehicle and monitor both market value and your payoff trend. By months 7 to 9, consider only those cosmetic fixes that add more value than they cost. Around months 10 to 12, reassess equity and reliability. If equity is positive, you can consider selling or trading. If not, continue holding and paying down. Now let's reinforce legal strategy with a quick knowledge check. Here is the second quiz. Which statement about used car protection is most accurate? Option 1. Lemon laws typically protect most used car buyers automatically. Option 2. Your recourse depends on the written warranty you received at purchase. Option 3. If the car breaks within 30 days, the dealer must fix it for free. Option 4. As-is sales still require dealers to cover major engine failures. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that your recourse depends on the written warranty you received at purchase. Standard lemon laws generally do not apply to most used cars. If the vehicle was sold as DS, you are usually responsible for repairs, even if problems arise quickly. Next, let's capture the essentials in a quick mind map of your options. This mind map places the recovery challenge at the center and expands into 5 branches. The repairs branch covers obtaining multiple quotes, prioritizing safety, negotiating parts, and confirming any warranty coverage. The finance branch focuses on avoiding rolled-in negative equity, making principal prepayments, and maintaining a realistic budget. The legal branch reminds you to rely on the written warranty terms, recognize the limitations of as-is sales, document everything, and use an independent mechanic. The market timing branch emphasizes holding the car until equity is positive, tracking value and payoff trends, and deciding between private sale and dealer trade. Finally, risk management highlights sustaining an emergency fund, following a maintenance schedule, and thoroughly testing the car after repairs. With the big picture set, let's consolidate the must-remember points. Here are the key takeaways. Early trade-ins crystallize losses during peak depreciation. Rolling negative equity into a new loan compounds the problem through higher balances and interest. Legal protections for used cars are limited, so your written warranty is what matters. The best overall path is to repair the vehicle, continue driving it, and pay down principal. Reassess your options after reliability is established and equity improves. To close us out, let's summarize and set your next steps. In summary, get an independent diagnosis and multiple repair quotes. Fix safety-critical issues first and negotiate parts and labor. Drive the vehicle while aggressively paying down principal to rebuild equity. Only consider a trade or sale once the vehicle's value is clearly above your payoff. Throughout, track your progress on a timeline and document everything for leverage and clarity. As we wrap up, I have a quick final request to help this content reach more people who need it. Thank you for watching. If this video helped you avoid or escape the early trade-in trap, please like, share, and subscribe so others can benefit too. Share your story or questions in the comments, and let us know what topics you want covered next. Your engagement helps this content reach more people facing the same challenges.